Have you ever wondered how a real seasoned market strategist would actually go about investing $1 million? Not just in theory, but with a concrete plan? Well, today, that's exactly what we're going to do. We're breaking down an expert's detailed strategy for long-term growth. So let's set the stage. Our client is 30 years old. They've got $1 million to put to work. They've got a good income, a really long time horizon, decades really, and this is key, a high tolerance for risk. The goal here isn't just to tuck money away. It's to build some serious, life-changing wealth. So where on earth do you start?
Right out of the gate, the first move is a big one. A full 50% of the entire portfolio goes straight into equities, stocks. See, for a young investor who has time on their side, stocks are the engine. They're the primary driver of growth. This isn't about playing it safe. It's about using that long runway to your advantage for maximum growth.
So here's what that looks like. Half the pie just dedicated to stocks. But of course, the real secret sauce isn't just saying buy stocks. It's about which stocks, and just as importantly, where in the world you're buying them. This 50% slice is the foundation that everything else is going to be built on. Okay, so let's break that down. Of that big 50% chunk in equities, the lion's share, a full 30% of the total portfolio, is going straight into the US market. Now, you hear a lot of talk about bubbles or corrections, right? But according to this strategist, having exposure to the US is simply non-negotiable. And the reason why comes down to one absolutely critical factor: liquidity. So what exactly is liquidity? Well, think of it like this. It's how fast you can turn your investment back into cold, hard cash without crashing the price. The US market is like this giant, bustling bazaar with millions of buyers and sellers all day long. That means you can get in or out of a position whenever you want. Your money is never, ever stuck. And that, right there, is the ultimate safety net. All right, so let's see how all these pieces fit together inside that equity slice. We've got our core 30% in the US, right? But the other 20% gets spread around the globe. We're putting 10% into India and another 10% across other really promising regions like Central Europe, Japan, and Southeast Asia. This is how you get that perfect mix of US stability with a shot of high-octane global growth. Now, you might be asking, why India specifically for that 10%? This isn't just throwing a dart at a map. It's a strategic bet on some really powerful fundamentals. You've got a super young population. I mean, the median age is 28, which means a huge workforce and tons of consumer spending. You add in rising incomes, a booming manufacturing sector, and a stable political scene. And what you have is a recipe for some serious long-term growth. And what about that other slice, Central Europe? Places like Poland or the Czech Republic. Well, the big idea driving that investment is a huge global trend called friendshoring. Basically, as things get more tense on the world stage, big Western companies are pulling their supply chains out of countries they see as rivals and moving them to nations that are political allies. And get this is not just some theory. This year alone, the stock markets in those Central European countries have returned, on average, a whopping 40%. That is an incredible return, and it's being fueled directly by this massive reshuffling of global trade. It's a perfect example of how you can invest by following these big macroeconomic shifts. All right, so we've built our growth engine. It's humming along. Now we've got to protect it. The next 15% of the portfolio goes into precious metals, gold and silver. But the philosophy here is so important. This is not about trying to make a quick buck on gold. No, this is about buying insurance to preserve your wealth for the long, long haul. And this slide just lays it out perfectly. We are not treating gold like a stock, where you're trying to buy low and sell high. We're treating it like an insurance policy. Its job is to be the calm in the storm. When other assets are going haywire, gold is supposed to hold its value or even go up. It's the defensive line for our high-growth offense. And if you want to see this in action, just look at the 2008 financial crisis. As the entire global economy was basically melting down and central banks started printing money like crazy, what did gold do? It went on an absolute tear, more than tripling in just 4 years. It proved itself to be the ultimate safe haven asset. Okay, so our foundation is solid, our insurance policy is in place. Now we get to look to the future. This is where things get really fun. The next 15% of the portfolio is dedicated to what we're calling thematic bets, investing in the massive megatrends that are going to shape our world for decades. And I mean, just look at some of these themes. We're talking about DNA sequencing changing medicine forever, private companies heading into space, the non-stop need for cybersecurity. These are the waves of the future. Now, for sure, these are high-risk, high-reward plays. But by dedicating a small part of our portfolio here, we get a front row seat to what could be absolutely explosive growth. But you're probably thinking, how in the world do you invest in a whole concept like space exploration? It's not like you can buy shares of SpaceX on the stock market. Well, the answer is an ETF, or an exchange-traded fund. Think of it like a basket that holds dozens of different companies, all related to one theme. So for space, you get rocket engine makers, satellite companies, GPS providers, all in one simple purchase. It's the smartest way to get exposure without putting all your eggs in one risky basket.
Okay, it's time for the wild card, the most speculative, high-octane part of our portfolio, a small 5% slice dedicated to cryptocurrencies. This is our moonshot. It's a small enough piece of the pie that if it goes to zero, it won't sink the ship. But if it takes off, it could offer some truly incredible returns.
Now, this right here is a really, really crucial point. You have to separate the technology from the asset. Blockchain, that's the secure digital ledger system, is a proven innovation. I mean, huge companies like Walmart and Louis Vuitton are already using it. But cryptocurrencies, they're just one application built on top of that technology, which makes them way more speculative. We're betting that this use case has potential, all while knowing the underlying tech is solid.
And this quote from the strategist just perfectly captures the logic here. It's really all about opportunity cost. The risk of completely missing out on what could be a paradigm-shifting technology might actually be greater than the risk of losing this small, controlled investment. It's a calculated bet on what the future might look like. So there you have it. We've laid out the whole portfolio, right? From the stable foundation all the way to the speculative moonshot. But you know, having all the right assets doesn't mean a thing if you don't have the right mindset to manage them. And that brings us to the final, and honestly, maybe the most important piece of the puzzle, the psychology of a great investor.
I love this. It's such a brilliant rule of thumb for dealing with all the fear you hear in the market. Think about it. If everyone you know is worried and asking, are we in a bubble? That's actually a sign of a healthy, rational market. The real danger, the real sign of a top, is when everyone goes quiet, when nobody is asking questions anymore, and they all just assume prices can only go up.
Okay, get ready, because this slide might just flip your whole idea of success upside down. With a disciplined 1-to-2 risk-to-reward ratio, you can literally be wrong most of the time, 60% of the time, and still make money. Just look at the math. You make 10 trades, you lose 6 of them, but you're disciplined. You cut each loss at just $1 for a total loss of $6. On your 4 winning trades, you let your profits run to $2 each for a total profit of $8. So what's the end result? You're up $2. This is not about being right all the time. It's about smart, disciplined risk management. And we're going to end on this powerful, provocative idea. In a world with inflation, the biggest risk you can take isn't always making a bad investment. Sometimes it's making no investment at all. Every single dollar you have sitting in a savings account is slowly but surely losing its buying power. So the real question isn't if you should invest,